Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, March 27th, 4:51 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market. We are in a correction. Tech continues to outperform. Check over here on the trend gauge. We've got leaders at neutral with a sub arrow toward bullish. Leaders are holding up fine. They are being held back by the overall state of the market and fears from the banking crisis and the possibly looming recession that everybody's talking about. So the market does climb a wall of worry, but uh, the fears from what the liquidity issues with the banking sector and the fact that it's expected, as Powell mentioned, to act as an additional interest rate increase as like a drag on the economy. So um, not a good sign there, but we've got a lot of leading stocks that have been holding up. They're forming bases. They're in several cases break out and then pull back and flag into their pivots or a little bit back below. But all in all, we've got the leadership that we need. We need the market to cooperate. Short term, in a downtrend, second close for the S&P 500 above the 21-day moving average today, but it was a weak close as we sold off into the close, and a gap up into S&P 4,000 level failed again. Medium term, below the 50-day moving average. The NASDAQ 100 continues to be the exception across short term and medium term, but it can't do it all by itself. And long term, flashing neutral here. Dow regained the 200-day moving average today, so now it's just the small and mid cap indexes that are below. But again, we need to see some additional strength. So what happened today? Gap up overnight. We they found a buyer for SIVB, or what was left of SIVB. The administration said there would take steps if they needed to shore up additional deposits. So the market gapped up 0.6%, but didn't go much further than that. Ran into this 4,000 level that's been resistance. Pulled back from there, gave it another shot late in the day, but then sold off the last hour. And what was notable was rotation out of tech, semiconductors, and QQQ, big tech stocks, weak for the second day in a row. Here are the final numbers. RG7, we added a seventh ETF. We added SLYG, that's the growth component of the S&P small cap 600 to our calculation. So our 7 growth ETF composite up 0.7% today. S&P up 0.16, disappointing after the 0.6% gap up. NASDAQ 100 lagged all day, ended up down 0.7. Dow showing some strength, up 0.6. Mid caps up 0.9. Russell 2000 up 1.1. Global diversified 60/40 down 0.13%. It was bonds that dragged this lower today as bonds across the board, prices were down, meaning yields were higher. In-house GROTECTION, we'll talk about it when we go through the tail of the tape in the charts, but we lagged today primarily because of our 2 semiconductor stocks and ONON finally pulling back after 4 fantastic up days, 4 days, including its gap up day. So let's get right into the charts here. We'll start, as we always do, with the S&P 500. Revere Asset Management is an active asset manager. We take a look at the major indexes and how they are performing versus various moving averages, horizontal support, accumulation distribution, and how leaders are acting. And we get extremely defensive if the market is below the 200-day moving average. The reason for that is that all bear markets, that's where they take place. So you don't know if once you break under there, it could be a crisis type thing with a harsh sell-off, like COVID, down 35% in 5 weeks. It could be like the bursting of the tech bubble and the financial crisis. We're down over 50% over a course of a couple of years. It could be a slow grind lower, which was more in keeping with last year. We had 3 rallies off the lows. Every time we ran into the 200-day, we would fail. The market down 27.5% at its high to low. Uh, and we just our number one job, we're a little bit different from most asset managers. We follow William O'Neill's principles. We look for leading stocks and the leading sectors in a strong market, and we recognize when the market's not strong, not only do you need to avoid leadership stocks, you need to get the heck out of the way if we're under the 200-day moving average. And if you're interested in this approach, reach out to me. The email's don@revereasset.com. You can also contact my partner, Dan Stewart, Dan@revereasset.com, or you can call us at 855 Real Wealth. That's 855-732-5932. So uh, break above the 200-day moving average in January. Had a nice little rally off the low, off of this base that we formed in December. Started to pull back, bounced at the 200-day right where we needed to. But then here's the key day here, 3/9, March 9th. This is when the banking crisis came to the fore. We had 3 harsh days of a sell-off, but we did put in that bottom so far. And I talked about this in the weekend video. I was surprised that how strong the final weekly numbers were, as we did put in the bottom on 313. And ever since then, if you go to the 60-minute chart, you can see we've been putting in higher highs and higher lows, notwithstanding the fact that we had a really nasty sell-off after the Fed last Wednesday afternoon, another nasty sell-off in the afternoon with some just dumb comments from Janet Yellen. And but the bottom line is these are higher lows when we're pulling back. Uh, 39, 38, 38, 39.01, 39.09, and higher highs 39.37, 64, 40.39. So now we've got a situation to where who's going to win? Are we going to make a higher high? Well, we got to get above and stay above 4,000 for that to happen. We ran into 4,000 and failed on 321, got above it and failed on 322, got above it and failed on 323, approached it and failed today on 327. So very clearly, 4,000 is the level that has been providing resistance for the S&P 500. Let's go to the daily here, and you can see that's also corresponds 14 points above that is the 50-day moving average, which we got above but then failed again on 322. Second close above the 21-day EMA, which is slightly trying to hook higher, and 2 bounces off of the 200-day, actually 2 undercut and reclaims of the 200-day last Thursday and Friday. So mixed bag. The bulls have things that they can point to, the bears have things that they can point to. But right now, tight range coiling, really looking at this 60-minute charts, and we need to decide what we're going to do. So we got 3,900 to 4,000 is really the area that we're coiling in, really since we pulled back to it and got above 3,900 the week of the 16th. Pulled back, held higher highs and higher lows for now. So we know very clearly the levels that we need to take out. 39.09 to the downside, 40.39 to the upside. But of course, bulls would settle for a close above the 4,000 level. You've got several areas of resistance over here on the left side of the chart: 40.17, 40.28, 40.18, and then the spike high 40.39 from last Wednesday. So bulls, the levels are pretty clearly defined. The question is who's going to take it out, the bulls or the bears? Let's go to the NASDAQ 100, which had been the leader. Most of that leadership came 2 weeks ago when the NASDAQ 100 was up over 5%. Slight outperformance last week as we hit this resistance around this 313.68 area, got above it and failed on Wednesday, got above it and failed on Thursday, couldn't quite get to it today, kind of in keeping with what we also saw on the S&P 500, but a red close today, down 0.7. But despite that, still trending above the ADMA. You're trending above an uptrending ADMA. You're all in good shape despite the relative weakness over the last 2 days. Let's go to semiconductors very quickly as they've been playing a big role. First close below the ADMA for semiconductors today. So that's something to keep an eye on. You can see we've got an alert set at the 21-day moving average on semiconductors because they had been leading the NASDAQ, but they also failed on those two breakout days last week, and we got a hook from overbought uh, in the daily stochastic. So certainly something to keep an eye on. Bulls would like to see a bounce at the 21 here, and that would also help out the NASDAQ 100. Anything that helps out the NASDAQ 100 helps out tech, which of course helps out the S&P 500 because that's the biggest component of the S&P 500 is tech. Note the 2 days of relative weakness also there, very much in keeping with what you're seeing on the S&P 500. Let's go to the Dow Jones Industrial Average, which is trying to take that relative strength baton from the NASDAQ 100. Got back above finally, and it closed. We had one close on the 21st above the 200, failed 3 days in a row. One close above it, couldn't get above the declining 21, so that's the next hurdle for the Dow Jones Industrial Average to overcome. And additionally, we certainly want to hold above this 200-day moving average, which they're only 0.2% above, but we'll take a hookup on relative strength for the Dow because relative strength in the Dow has been hard to find lately. Let's go to MDY, mid caps. Undercut last Friday, I mentioned that. So very critical now that last Friday's lows hold on mid caps. And a lot of that is going to be dictated by what happens with banks. Here's IWM. Also an undercut of the recent lows, closed right on the ADMA today. So some relative strength on small caps and mid caps over the last 2 days. No doubt this 170 area is huge for small caps. And of course, let's take a look at the bank ETFs. Here's XLF, closed right on the declining ADMA. Here's KBE, the larger banks. Got above, but closed at the bottom of the range, gap up. But we gave up most of that gap up today for KBE, KRE even more so. Only closed up less than 1% today after being up over, I believe, 5% at one point. PACW, FRC, and Deutsche Bank all did. Those are the three that are the world is primarily concerned about. Those three all did close positive today. So let's go to some other indexes that are critical. Let's go to UUP, the dollar up today, hooking up the stochastic from overbought. That's not a good sign for stocks, although it didn't really appear that the major indexes have been paying as much attention to the dollar lately as they had been prior to the banking crisis. Let's take a look at the VIX. VIX down 5% today, back below the 21, sitting on the 50-day moving average at the lower end of this range. For it closing at the low of the day, we sure didn't get as good a close on the S&P 500 as we might have expected. Let's flip to bonds. Let's go to TLT. This is the long-term bond ETF, down 2.4% today. Closing near the bottom of this range now. So, price down, that means yields up. That's what the Fed kind of wants to see. And it might mean that some of the fear has been taken out with the rush into TLT. Actually, the selling of TLT today after the rush into it last week drove prices up and drove yields lower. BND broad bond index down by 1%. LQD corporate bonds down by 1.2%. Junk bonds, JNK, down fractionally. And let's look at the yields now. We'll start with the 10-year. Big jump up in the 10-year yield, up 4.4%. Again, indicating that perhaps some fear coming out of the market relative to the bank crisis. And then TYX, the 30-year, up 3.2% today, near the top of this range, looking quite a bit different than TNX. Notice how this bounce occurred off the 200-day moving average on TYX. TNX made a lower low last Friday, which the longer term didn't even come close to doing that. Let's flip over to precious metals now. with the dollar being weak today, it didn't help gold. Then this again may be a case of the fear trade being over. Gold down 1%, although it did close at the top of the range, and also at the top of this. Closed right near this breakout level from this big cup and handle, which you can see on the weekly, and it's pretty nice looking cup and handle here. So breakout, we frequently revisit the buy point on cup and handle breakouts, whether it's a growth stock or any other index or ETF. That's the case with gold here. But again, the fear trade may be dictating what happens next with gold. Silver, SLV, basically flat today, and GDX gold stocks. Uh, Note how they didn't break out the way gold did, and they were down today also, although just slightly. So those are the major indexes that we track in all videos. Let's go to the tail of the tape now. You can pause this to go through everything. I'm going to hit the highlights. There's the gap up, reduced bank systemic fears with SIVB finally being sold. Day count from up 1 to a week, up 2, with a gap up in the close below that. So yeah, second day up, but kind of considered weak. Also, the second close above the 8 and the 21 on the S&P 500, as I note there. However, on the downside with the levels, above and fail at this 4,000 level again on the S&P 500, NASDAQ 100 above and failed at this resistance range as it lagged today. Here's the intraday action. Here are the sectors that underperformed and outperformed. Uh, and here are our holdings. We added 10% UPRO today on the after the test and pull back to the 21 and how we showed a little bit of strength. We're about even on the two buys, maybe down by slight if you combine the two of them. Profitable on one of them, down slightly on the two of them. But 10% UPRO adds to our beta, which is now up from 0.59 to 0.89, or 9/10 of the S&P 500. A little bit of a higher standard deviation because only 30% of that is in index ETFs. So the bottom line for today, S&P 500 gapped up but failed again at 4,000, and we rotated out of tech into the weaker sectors like your basic materials, industrials, financials, and staples. Oil's also strong today. Let's take a look at XLE very quickly. Oil looks like it's trying to put in a bottom here, or at least XLE looks like it's trying to put a bottom. Here's USO, which is the ETF for oil, making a 2-week high there also. So let's see. That's it for the tail of the tape. Let's go to let's take a little stride through the portfolio. I already looked at GLD. Several opportunities or thoughts about adding to some of these today, but we never want to chase a Monday morning gap up after a strong Friday close. You're just setting yourself up for a pullback, and then the pullback is what we got. But we would certainly have preferred. Let's go to the 5-minute on the S&P 500. We certainly would have preferred that this afternoon strength hold. So basically, making the high in the morning. There's some time missing from this chart, but over 4,000 and then pulling all the way back to 39.70, going sideways for a little while, trying to break out, get into 39.97, and then sell off into the close. But everything that we own, no issues with them, holding up pretty well. We'll start with NVIDIA. 2 tight days here, hasn't even touched the ADMA. Very clearly a leader focused on AI, among other things. TMDX regaining the 21. This has been tight for like the last 3 weeks, right along the 21-day moving average. ANET, no give back. Our smallest position, as we sold it when it was extended. It's less extended now, but that doesn't mean it's not continuing to go higher. And the relative strength pulled back a little bit the last 2 days, but not enough to give us. We want to at least see a pullback to the 8 here if we are adding to our small position on this, and it will require great strength in the market too. Palo Alto broke above the 190 level, and it's holding it on pullbacks, but can't get too far above this 193 level, which is the high after its earnings gap up. First Solar pulled back to the 21 after its earnings gap up, riding above the ADMA. AMD taking a little bit of a break after its attempt over the Livermore 100 area, bounced at the ADMA today. Tesla was very strong early, faded. Can see this is 3 of the last 4 days that it faded into the close. Can't get above this 200-day level or 200 area, or the 200-day, which is another 17 bucks above that, but sitting on the 21. GLD, we already showed that, pulled back to the pivot, and sorry, ON. After 4 monster days, a pullback on less volume. So some good stuff here. First of all, held the 30 level, which was also Friday's low. So basically, it undid Friday, down 4.5% on the day. This accounted for most of our underperformance in the portfolio today. But volume patterns continue to be fine. The first pullback day was the lowest volume of the 4 up days. Let's take a look at a weekly chart on this, and that is one really impressive weekly bar. If we hang around up here, we could look for something called a short stroke from O'Neill, which is a big move up, and then just barely consolidate before taking off higher to the upside. So see if that happens. Anything else stand out today? I don't think so. So that's going to wrap it. So remember, it's not how much you make in the market, it's how much you can keep. We're at a point in the market where we really could go either way, break out to the upside, above 4,000, or back below the 21 and the 200-day moving average. So we'll see what the rest of the week brings. We've got a plan to cover all scenarios as always. And if you're interested in this approach, certainly reach out to me, Don at RevereAsset.com. So wrapping up Monday, March 27th, this is Don Vandenbord telling it like it is. Thanks for listening and have a great day.